would want you to know both. So in some cases for goodwill, you will get here like consideration paid by the parent. Consideration paid by parent. You'll get, for example, consideration paid by parent, 10,000. And then we have here NCI at fair value. NCI at fair value, for example, 3,000. And then you will have net assets. Net assets. In this case here, 5,000. So this is NCI at fair value at acquisition, remember. At acquisition, remember. At acquisition, remember. So if, for example, you're given this kind of analysis and the subsidiary is basically a 60% subsidiary. It's basically a 60% subsidiary. And then you are required to calculate goodwill, using full method. Calculate goodwill using full method. Using full method. This is when we consider both considerations paid by the two parties. When you consider what has been paid by the two parties, then automatically you are accounting for the whole, for the full. So when they tell me to use full method to compute goodwill, then what I will do is to come here and they say consideration paid by parent. Consideration paid by parent, 10,000. And then I add who? I add consideration paid by NCI. Consideration paid by NCI. NCI in this case here is 3,000 to get full consideration. What we call full consideration. To get full consideration. And once you get full consideration, then you will come and subtract net assets in full. You subtract net assets. You subtract net assets in full. You subtract net assets in full. You subtract net assets in full. In this case here, net assets ngiri 5. Ukisubtract hapo kuna ngiri ngapi? Ngiri 8. This is your goodwill at acquisition.
Sawa, 134 basi. 134.
Sorry.
134.
Sorry. Goodwill. Acquisition.
And then South Asian walikuwa wananipea 134,800. 134.8.
Huyo mtoto si mwerevu sana. We shall overcome. So in this case here, full method, I want to believe full method hakuna problem. Kutoka hapo sasa unaenda kwa partial method. Unasikia partial method D. Calculate goodwill using partial method. So partial method, what you do, you only consider consideration for partial method. You only consider consideration that has been paid by the parent alone. So in this case here, you come and give us consideration parent. Consideration parent. And the parent has paid us how much here? Has paid 10,000 for the subsidiary. If you don't consider NCI, then also you shall forego the net assets of NCI. NCI's net assets are 40%. We can only take, in this case here, net assets of the parent alone. The parent, in this case here, who owns 60%. So you come and less here, net assets of the parent, net assets of parent only. And in this case here, the parent, we are talking of 5,000. Now times, remember, we only own 60%. So 60% of 5,000, this gives me what here? 3,000. So of course, you can see we are getting different answers. And I believe this small example has been able to bring home this concept of partial and full method. Is it clear now that when I go to an exam and I get a question where the examiner tells me to use partial method, or where he does not give me NCI fair value at acquisition, if he doesn't give me NCI fair value at acquisition, then I will always use what we call partial method. I'll always use what we call partial method. I'm not getting responses. Are we okay up to here now? Are we okay up to here? Great. So then we come back to our question really. So our question is about plugging in. Let's plug in. Our question, let's plug in. Already you guys have answers. We have a subsidiary in Rwanda. And this subsidiary that we have in Rwanda, the subsidiary that we have in Rwanda, if we read, we are told H Limited, that is November 2016. November 2016. November 2016. Question number 1. We are told H Limited, a public limited company based in Kenya, owns 75% of the ordinary share capital of S Limited, a public limited company based in Rwanda. H Limited acquired S Limited on 1st May 2015 for 1,200 million Rwandese francs, not Rwandan francs, Rwandese francs. So in this case here, Rwandese francs, 1,200. So in this case here, consideration paid by parenting. Consideration paid by parent ni 1,200. Kumbuka hapa hii lazima ikuwe in terms of Rwanda francs. Kama unakumbuka tulisema goodwill is normally computed on the basis of the currency of that foreign country. So unakuja unatafutilia hapo straight away fair value of NCI. Fair value of NCI at acquisition. Have they given us fair value of NCI at acquisition? Have they given us fair value of NCI at acquisition? Fair value of NCI at acquisition. Fair value of NCI at acquisition. Nyinyi mnaiona mahali kweli? The functional currency is like that. Functional whatever is like that. Najaribu kutafuta NCI. Wanasema goodwill is reviewed for impairment annually as at during the year. Hiyo itanisaidia. H Limited issued an interest-free loan. Hiyo itanisaidia. The fair value of the net assets at the date of acquisition is assumed to be the same as carrying value. Hiyo itanisaidia. The company, it is a group policy to value NCI at acquisition at its proportionate share of the fair value of the subsidiaries identifiable net assets. Nikisikia hivyo, straight away najua kwamba they want me to make use of what here? Partial method. They want me to make use of partial method. So in this case here, NCI, fair value of NCI at acquisition, hii kwanza wekelea tu dash namna hiyo. Kuja hapa straight away, tuambie straight away kwamba this is the total consideration paid. Total consideration paid. So the total consideration paid is 1,200. And then you will come and now less net assets at acquisition. Net assets at acquisition. So here I'm taking a shortcut. I never did the net assets. I'm taking a shortcut because you told me, Mwalimu, we only want one thing alone, which is goodwill. So at acquisition, I will go to the equity elements. So we have here share capital. We have in this case here share premium if there is any. We have retained earnings, and then we have any fair value adjustments that took place at the beginning of the year. I'll always cram this. So tuanze na share capital. Please hapo unaangalia balance sheet. Balance sheet ya subsidiary. Balance sheet ya subsidiary, what do we have there? Balance sheet ya subsidiary, what do we have there? Am I able to see these things? Balance sheet ya subsidiary. Abracadabra. Balance sheet ya subsidiary, I can see things, great things there. Ordinary shares ni ngapi? Nimeshaona tayari. Ordinary shares ni ngapi? Ordinary share capital ni ngapi? Nimeshaona tayari ni 320. Thank you very much. Haya, kuna share premium kweli? Kuna share premium ya S ya subsidiary 200. Thank you very much. Kuna retained earnings kweli? Retained earnings kweli? Uongo. Retained earnings kwa acquisition hauwezi ukachukua at the end. Wananiambia mwalimu retained earnings at 950. Retained earnings at 950. Hebu soma retained earnings vizuri, note taona mwalimu ambaye about retained earnings at. Are you able to see that note somewhere there? Talking about retained earnings. The note, where is the note? Where is the note telling us retained earnings at acquisition? Where? When the retained profits of S Limited were what year? 800. So remember, this is net assets at acquisition. Tunajua hii na hii haichangingi. Hiyo huwa haichange. Lakini retained earnings lazima nikuwe mwanafunzi hodari. Lazima nijue katika goodwill computation, we normally work with retained earnings at acquisition. acquisition. Now, how about any revaluations? Kulikuwa na any revaluation? Kuna note nasema kuhusu revaluations. The fair value, not for, the fair value of the net assets of S Limited as at the date of acquisition is assumed to be the same as the carrying value in the companies in the same as carrying value. So is there any fair value valuation? Nothing. So are you able to give me this total, ladies and gentlemen? Are you able to give me this total? Are you able to give me this total? Are you able to give me this total? Aha. Are you able to give me this total? Ukiongeza na kuja ngapi somebody? 1320, right? Wanasema 1320, right? So in this case here, the total is 1320. But now remember that these are total net assets. These are total net assets. And yet, the examiner has told you to use partial what? The examiner has told you to use partial method. So it tells you to take partial method, come and take a proportion of this. The parent owns how much? The parent owns what percentage? The parent owns what percentage? 60 or 75? The parent. Kendi anakumbuka ile example yangu mbaya. Kendi anakumbuka example yangu mbaya. Kendi, we shall overcome. No wonder you were sleeping. We shall overcome. Although utaamuka sasa mara moja. 75%. So 1320 times 75% gives me what figure? Gives me 990. So this 990 is what you subtract here. So then can you kindly give me the final answer, which will be the goodwill at acquisition? This will be the goodwill at acquisition. So goodwill at acquisition is 210. Aya, sasa nisikizeni vizuri. Utakuta sijui kind of method ambayo mmezoea. Utapata mwingine aliniambia mwalimu sisi tumezoea method 2. Where in this case here they come and they say parents consideration. The parents consideration is 1200. And then we have here NCI at acquisition. They'll tell you if the net assets here are 1320, mwalimu, we know that the NCI percentage is 25. NCI percentage is 25 because if the parent has 75, then NCI has 25. So then what is 25% of these net assets? Can somebody give me this 25% of the net assets so that 320, yeah? Merab is giving me a figure of 320. Merab is giving me a figure of 320. Is she the only one who is able to see that 320? 330, yeah? 330, right? 330, Mary Ann. Why they are not giving me? Remember, wanakuambia kwamba NCI is to be valued at its proportionate share value of the net assets. 330. Kwa hivyo sasa akifanya hivi, hii sasa hata take percentage. Hii sasa ni full. Hii sababu niko nazo hizi ni full. So hii pia inakuwa pia full. Ukisubtract oye, utapata goodwill the same. Utapata goodwill ukichukua this plus this minus this. Utapata ngapi? Is there somebody who can give me this answer? 210. So which method do you rather we work with? Method 1 or method 2? Which method is better? I can say like Veronica is saying, that is what I did. Method 1 or method 2? Whichever. Lakini sasa kumbukeni. Hii umepata hapa, umepata goodwill at acquisition. Ukitaka free marks. For a foreign subsidiary, wamekuja hapa wakakupatia goodwill, umepata nini? Goodwill at acquisition. This goodwill at acquisition translate it very fast. Translate at the acquisition date rate. What you guys call historical. The historical rate. Are you able to see the historical exchange rate given there? Are you able to see the historical exchange rate given there? Are you able to see the historical exchange rate given there? Is there anybody who can see this historical? Historical is the same as the date when this subsidiary was acquired. When the subsidiary was acquired, you must always read and understand that this subsidiary was acquired on 1st May 2015. 1st May 2015. So 1st May 2015 is when I can see 2.5 Rwandese francs. So remember, you guys gave me a figure of 210. So translate this at 2.5. At 2.5 Rwandese francs per Kenya shilling. So kumbuka pia hizi ni Rwandese francs. Hizi pia ni Rwandese francs. So niambieni sasa hizi Rwandese francs to convert, do I divide or do I multiply? Yes, I divide. Thank you very much, Valentine. I divide kwa sababu kama hizi ni Rwandese francs na hizi ni Rwandese francs, wewe kuja hapa divide. Ndio Rwandese francs ziishe. So ukidivide mulipata ngapi somebody? Ukidivide mulipata ngapi oye? Ukidivide mulipata ngapi? 84 84. Ukidivide tulipata. So hapa tuko na acha nipange namna hii. Wacha nipange namna hii. So tuko na goodwill is 210. Tuko na exchange rate. Exchange rate umesema ni 2.5, giving us in this case here in Kenya shillings umesema ni 80 something. Yeah, there is impairment loss, Yeah, there is impairment loss. Kwanza wewe nikumbushe, wewe umesema 210 divided by 2.5 imekuja ngapi? Nikumbushe kwanza hiyo inakuja ngapi somebody? Inakuja 84. Thank you very much. 84. Alafu hapo unakuja unasema kuna impairment loss. So impairment loss ni ngapi from the note? Impairment loss from the note ni ngapi? Impairment loss wanasema from the note is 42. So if you subtract in this case here, then what do we have as a goodwill? Goodwill at reporting. Goodwill at reporting inakuja ngapi? Goodwill at reporting ukisubtract inakuja ngapi oye? I hope the 42 or it's 42 Rwandese. Somebody is floating big time. This 42 is Rwandese francs, Kumbuka hizi ni Rwandese francs. These are Rwandese francs. So 210 minus 42 inakuja ngapi? Inakuja 168. I can see students complaining that they are floating. The most important thing, ladies and gentlemen, that I would want to sell to you here today is just like when they tell you to do the goodwill account, just the beginning part of it, like getting up to goodwill at acquisition. Goodwill at acquisition. So this student, the student who is saying they are floating, were you able to get up to this 210? Were you able to get 210? Great. Hiyo mambo mengine exchange na kwanza kupata exchange losses, hiyo tuachana nayo kwa sasa. So the only thing that I would want to do for you now, of course, is not any other consolidation question. Although still tomorrow tutafanya ingine moja ile ya high level. For now, I would want us to discuss so sana nataka to get katika very serious business. I would want us to discuss a few questions here. Just a moment. Great. We shall overcome. Now, I would want you to do me a favor. I would want you guys to outline 4 disclosure requirements for a reportable segment. Disclosure requirements for a reportable segment under IFRS 8. I repeat again, you outline 4 disclosure requirements for a reportable segment under IFRS 8. So what are these requirements in this case, ladies and gentlemen, that you're supposed to report on? For you to be able to tell us straight away that this is a reportable segment. What are those requirements? Okay, so this is a very serious exercise, and if possible, I repeat again the question: 4 disclosure requirements for a reportable segment. for a reportable segment. I can see most of you are talking about the 10% rule. Disclosure requirements. What are you supposed to disclose, ladies and gentlemen? Number one, you must tell us the criteria that you used to arrive at whatever segments that you have, to arrive at the reportable segments. What are these criteria? What are the factors which were used to identify the company's reportable segments? Because there could be very many. There are some segments in this case that are only contributing 10%. Others are contributing 1%. So first of all, you must give us the factors that you used to identify the company's reportable segments. Thank you very much. Number two, you must give us the revenue amounts, the profit stroke loss, the assets, liabilities of each reportable segment. So I'm repeating again, you must give us revenues, you must give us a PL, profit stroke loss, assets and liabilities of each reportable segment. All right. Information about transaction with customers. I love that. Information about transactions with customers, especially those customers whose revenues to us are more than 10%. We call them significant customers. Significant customers. Remember this quantitative criteria, the 10% revenue, 10% asset rule, Winfred. This comes under factors that you used to identify. Assets and liabilities, 10% rule. Yeah, like information on non-cash expenses. Non-cash expenses and the capital expenditure for each reportable segment. That is very good. That's very good. Remember, the question here is about us giving them what is to be disclosed for any reportable segment. For any reportable segment. Great. So then I would want us to pick another question here, which came in May 2019. Question number 1, dog. May 2019. Question number 1, dog. Question number 1, dog. Question number 1, dog. Oh, we need to share the, somebody is saying handout shared. There is already a handout which has been shared. Yeah, Lois, we've already said that significant customers, their transactions, any customer who is contributing, whose contribution is more than 10% of your revenue. That's what we call significant customers. You must give us information about them. What kind of transactions do you have with them? All right. The ones that you cannot forget, we have this concept of what, ladies and gentlemen? We have the concept of what here? We have the concept of like the revenues. We have, in this case here, assets, liabilities, ETC of each reportable segment, the factors in this case that you used to arrive at your reportable segments. We have the concept of significant what here? Significant customers. Then that should be really it. So have we gotten this May 2019 question number 1, dog? Do we have it? Do we have this? Do we have that question? Thank you very much. So we are told here with reference to International Public Sector Accounting Standards, IPSAS 20, related party disclosures, briefly explain the related party relationships and how related party disclosures under IPSAS 20 differ from those of commercial sector entities under IAS 24, related party. Ladies and gentlemen, remember we talk of related parties when one party is able to control another party. For example, if we have a subsidiary, we have a parent and a subsidiary. Automatically, the parent in this case here becomes who? A related party of this subsidiary. The subsidiary has to disclose this relationship because of the aspect of what here, control. So are you in a position of giving me examples of related parties? We start from there, the normal related parties that you guys know about. Give me examples, more examples. More examples of related parties, like joint ventures. I love what Kamutu you're writing there. Your joint venture is your related party, even associates. So long as you've got a control or a significant influence. Actually, that is it. Control or a significant influence. Anybody who is able to control you or somebody who has significant influence in you, automatically that person becomes who? A related party. And that is why I'm surprised there is nobody who is writing key management personnel. 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 Key management personnel, including their who? Their relatives, close relatives. For example, a director, the wife automatically becomes a related party. So if this wife, for example, does business with RCM Online College, then RCM Online College in the AGM, we must disclose that relationship. Why? Because we know most frauds, most of these businesses collapse because of a fraud, in this case here, done by who? These related parties. Right? I'm waiting to get, there are so many related parties. How comes you guys, you must have read this really. You guys must have read this. You guys must have read this. You guys must have read a lot about this. You guys must have read a lot about this. Let me get my handout because it seems I'm gonna use the notes to me. Just a moment. So we have here Nairobi. Aki wengi sasa hawazungumzi totally. Wengi sasa hawazungumzi totally. Nakutafutia handout, just a minute. The net misbehaved. Maybe you could assist. If you guys are not able to mention something to do with pension schemes, the pension plans, if you have a pension plan, then automatically you become a serious related party to that pension scheme. Because if you are not careful, then this party, the main shareholder, the one who is making that contribution, this guy will come and say, hey, give me part of that money. Give me part of that money. How is it disclosed in terms of financial statements? Of course, at the end of the day, you will simply tell us that we have a financial plan. We were able, a pension scheme, and we're able to, from our employees or whatever, we're able to contribute, like say 10 million in the year. 10 million in the year. And if there is any other business that you did with this pension scheme, you must tell us. especially if the pension scheme is what here is private. It's private. But the most important ones you guys have been able to mention, we have here subsidiaries, associates, joint ventures. We have key management personnel, close family members of key management personnel. Now, how about now under IPSAS 20? IPSAS 20, you know, it does not define these related parties as we define them in the commercial sector. Read the question. The question says, with reference to international public sector accounting standards, IPSAS 20, related party disclosures, briefly explain the related party relationships and how related party disclosures under IPSAS 20 differ from those of commercial sector entities under IAS 24. Okay, so then what will you tell us really there? What will you tell us? What will you tell us, ladies and gentlemen? Remember, under this IPSAS 20 government, so if, for example, ladies and gentlemen, we have the government of Kenya. Government of Kenya, of course, owns who? Kenyatta National Hospital. So automatically there is a serious relationship there. So should Kenyatta National Hospital in this case here get any donations, then they should be able to do what? To disclose that we got donations of this amount from the government. We got donations of this amount from these key stakeholders, from other donors from outside, Switzerland, etc. They'll have to disclose. They'll have to disclose. But there is quite, the same IPSAS also defines related party. The same way we define it in the commercial, that concept of control and the significant what here? Influence. The only difference that we have between IPSAS and the IAS, is this, and you should be able to write this down, that unlike IAS 24, IPSAS 20 does not require, IPSAS 20 does not require disclosure of information, about business transactions, between related parties, which occur at arm's length, what we call normal trade. Listen, ladies and gentlemen, assuming in government, we have this kind of related parties. We have a company A, like now treasury. We have, for example, treasury. Here, treasury, and then we have Kenyatta National Hospital. Of course, we know that the two, they are related, because this must be getting money for this. So assuming in the year, treasury takes their employees for treatment to Kenyatta National Hospital, and the treasury is able to pay fees, is able to pay, in this case here, whatever it has been invoiced by Kenyatta National Hospital, normally as if these guys that came over here are not our relatives. If, for example, we charge everybody 100 shillings in terms of whatever kind of service you're offering at KNH, and treasury people also paid 100 shillings, then we shall not disclose, because that is business between related parties, but at what here? At arm's length. No more trade. The prices liquid, they say the same. Then you don't disclose. In the commercial sector, even if, for example, we are selling this thing at 10 shillings, and then a director comes and buys it at 10 shillings, same price. In the commercial sector, you must do what? You must disclose. In the government sector, you don't have to disclose. Commercial sector, so long as this director has bought from this company, he has come and bought, for example, a car, it was valued So this car was valued at $1 million and he paid $1 million. Still, you must disclose because we appreciate outside here that theft starts like that. This time around, they'll pay normal market price. If you don't disclose, next time in this case, they'll start now thinking otherwise. What if we bring some valuer and the under states? Basically, according to IAS 24 related parties, the further we can put these related parties from our business, the more formidable, the more overgoing concern our company is. The moment you bring in related parties, so many of them, we have in this case here the wife to the director, they are taking goods from me automatically. That's quite a big loophole. So of course, they may ask you to state something to do with what here IAS 24 related parties, or IPSAS 20, where they tell you just give us a list. So when they tell you give us a list of related parties, please don't let me down and ensure that you are able to pick that very well. So can I move to another concept? Can I move to another concept? Can I move to another concept? Can I move to another concept now? Remember, mine is to speak very fast in a way that you guys will be able to pick these things, in a way that you'll be able to write something. We don't want you to return unmarked or rather unwritten papers. Simply because you could not really process anything in our mind. No, that will be very bad. That will be very bad. That will be the worst thing ever. Great. So remember, I'm giving you my question. That's what we agreed. I'm not taking questions from you. I'm the one coming up with the questions. I'm the one coming up with the questions. But of course, I'll also give you a chance to, especially for this. Very good, very good, very good. You see, like now in November 2015, question number 1, November 2015, question number 1, November 2015, question number 1. Do we have that question with us? Segment has a lot of theory. Actually, if I were you, I would really read information on segment reporting. I would read a lot of stuff on segment reporting. It has so many theory. Great. So like in the context of IFRS 3, business combinations, discuss how non-controlling interests are measured. So I'm giving you a minute. Give me an answer to that before I start speaking very fast. In the context of IFRS 3, business combinations, discuss how non-controlling interests are measured. Discuss. I like what Merab is at their fair value. I love that at their fair value. Not calculation, but remember, Veronica, also, if you can show us calculations, can you give us examples with XX? We really love that. We really love that. So if I'm the one doing this question, I will start first of all by defining what NCI is. Courtesy, you must be courteous always in an exam because you are begging this person here to allow you go to the next level. So I'll tell this examiner that non-controlling interest NCI refers to the portion of equity ownership. Refers to the portion of equity ownership in a subsidiary. In a subsidiary that is not held by the parent company. I repeat again. NCI refers to the portion of equity ownership in a subsidiary that is not held by the parent company. Have you been able to jot down something, however small, even in your mother tongue? So that if, for example, the parent has 75%, then NCI has 25%. I repeat again, it refers to that portion of equity ownership in a subsidiary that is not held by the parent company. And then you repeat there, according to IFRS 3, you cheat him that you are very good. According to IFRS 3, NCI should be measured. NCI should be measured at its fair value, at the date of acquisition, at its fair value, at the date of what year? Acquisition. I repeat again that according to IFRS 3, NCI should be measured at its fair value at the date of, we normally do two types of what here, two types of measurements. We have two types of measurements. When it comes to IFRS 3, measuring NCI. We have NCI, fair value of NCI at acquisition, fair value of NCI at acquisition, fair value of NCI at acquisition, fair value of NCI at acquisition. So at acquisition, we shall look at how many shares do these guys have? 10 shares. The market is willing to accept these shares at how much? Maybe 20. So take 10 times 20, 200. That is at acquisition. But again, there is another measurement which comes at reporting date. So to get NCI at reporting, we normally take NCI at acquisition plus share of post-acquisition profit less share of any impairment loss. So if you write like that, then the examiner will give you 4 marks out of 3. And I'm so sure you will get students wanting to discuss about partial method, about full method, partial method, full method. I even saw, partial method and full method. That's a very good, good concepts, but those are for measuring goodwill. They are for measuring or computing goodwill. So should they ask you about IFRS 3, how you measure goodwill, the methodology of calculating goodwill, then mention those methods. Are we in agreement? Are we in agreement? Are we? Katunge cannot talk there now. There Katunge will scream. We shall overcome. We shall overcome. We shall overcome. Again, there is another question that I saw the other time. This question, there were very few students. I can't remember the semester very well, but it must be a very old question. Regarding this IFRS 3, business combinations, we have company A, we have company B. Company A, and then we have company B. And then they tell you that B has become bankrupt. B has become bankrupt. So A owns B. A owns B. A owns B. But now B has become bankrupt. So then they're asking you, how will you treat B? How will you treat B in the group consolidation? At the year end, at reporting, how will you treat B? How will you treat B? Yes, Mary Ann, you can also write this in a format. Yes, you can do that. Always, if I'm the one doing this AFR, I cannot fail, because I'll even come and tell them, for example, if A owns B, if A owns, for example, 75% of B, so I'm giving them examples, NCI will be 25%. And this NCI, two things, at acquisition, I'll value it at what we call market price or fair value. And then, of course, as we progress the equity method, the net assets increase. That post-acquisition profit is what we shall be increasing and subtracting any impairment, etc. So always strive to use what your examples, pictures, drawings, we love like that. Okay, so in this particular case, so Kamutu is saying consolidate. No. Remember, ladies and gentlemen, and here you are supposed to be very wise. You're supposed to be very wise. IFRS 3 talks of what here? Business combination. It is two businesses, two or more businesses coming together. So if this thing has become bankrupt, it's no longer in business, then you cannot consolidate. You can't tell us that this business has got land alone, is not doing business. It's called the business combinations. Business combination. If one of them goes under, like the parent goes under, unfortunately, that will be the most unfortunate thing. Your parent dying is an unfortunate thing. Then you stop consolidation. You stop consolidation there. That's what we are told. According to even the language itself, what is the name of IFRS 3? It's a business combination. So if you are told that one of the companies, like the parent, dies, tell them that also consolidation dies. Will not consolidate. We remove. I like what Lois is saying there. That is the best language. We remove it from the consolidation processes, because it's no longer a business unit. It's no longer a business unit. Great. It's no longer a business unit. Yes, they have repeated this question severally. They have repeated this question severally. They have repeated this question severally. I don't know whether you have ever seen it. I don't know whether you have ever seen this question of mine. Is an interesting one. Just a minute. Is a very interesting one, where just somebody comes and tells you to explain 3 types of joint ventures. Explain 3 types of joint ventures. This is just a person who hates you for no reason. Imagine. Explain 3 types of joint ventures. For sure, a man cannot multitask. I'm trying to get a handout here to me. You don't do, even here, you can't take anything out of this from the balance sheet to the balance sheet. Nothing. horizontal, vertical project, but I can't explain any low-hanging fruits, at least. Joint arrangement, joint venture. So income statement, when it becomes bankrupt, you know, you'll just take the period when this thing was good, where it was still good, where it was still good, where it was still good. This could be 3 types of joint ventures or 3 types of joint what year arrangements. Joint ventures is better. Like what this person is telling me there, jointly controlled operations, jointly controlled operations, jointly controlled assets, and a jointly controlled entities. That you can come and say, we are only going to work on this operation. We are partnering to execute this project. So we just have an operation. We can, in this case here, come and basically decide to control an asset together. So we have jointly controlled operations, jointly controlled assets. We have jointly controlled who? Entities. Thank you, Kerubo. So jointly controlled operations, jointly controlled assets, and the jointly controlled what year entities. Let me get another thing so that I can connect what I'm talking about for even a better explanation, for even a better explanation, for even a better explanation. Now, there is this past paper that we are doing in the morning. This past paper that we are doing in the morning, it has got very good theory questions. If I was an examiner today, I would want to look at that particular what year paper. I would want to look at that particular paper, the one that we are doing in the morning, the one that we are doing in the morning, the one that we are doing in the morning. So we have here the one that we are doing in the morning. November 2019. Look at November 2019. November 2019. Is there somebody who can send us that paper on WhatsApp? We do all those theory questions. From them, you guys will come to thank me. Is there anybody who can send us that question paper of November 2019? November 2019, kindly send that paper to us. Send that paper to us. We look at a few theories which were there. A few theories which were there. Wametuma kweli ama bado? Wametuma kweli ama bado? Wametuma kweli ama bado? Wanafunzi hawa hawatumi hiyo paper. Wametuma manoti. Thank you very much. Thank you very much. Great. Haya, sasa wamekuja hapa. Nataka tuanze na November 2019 question number 1. A. International financial reporting standards are developed by International Accounting Standards Board through a formal system of due process and a broad international consultation involving accountants, financial analysts, financial statement users, and regulatory bodies from around the world. The overall agenda of the International Accounting Standards Board, IASB, will initially be set by discussions with the IFRS Advisory Council. Required Explain the steps that are followed in the process of setting international financial reporting standards. International financial reporting standards. The goodwill, how it was found. Okay. Okay. Yeah. So what are these basic steps which are normally followed in the process of setting? Like, this question keeps on coming every now and then, and these students are not able to remember. These students are not able to remember. How do we set? How is an IFRS set? That process, is there somebody who has even an acronym? Hiyo nyamaza kidogo nione the various steps that must be followed. Hiyo na conceptual framework haikosani kwa mtihani. Conceptual framework. So abracadabra, what do we have there? What do we have there? Abracadabra. Abracadabra, what do we have there? Why they are not even talking to me? They are not even talking to me. Okay, so ladies and gentlemen, the thing that you're supposed to know is that ISB normally follows a very structured process in coming up with the IFRSs. ISB haiwezi kaamuka hivi, hapana. ISB watakutana namna hii. The first thing they will do in the board, whenever they are, for example, like when they were setting IFRS 17 for insurance contracts, for insurance companies. It's a new standard. It's a new standard. So what they did, the stakeholders mmepiga kelele, mnasema now we should be able to do this and this and this and this. So they come together. Like a whole session, wanakuwa na meeting ya kuset just the agenda. The way board nafanya kazi, you set the agenda. And then now you know that we have a project at hand. When you have a project at hand, then you have to do what we call project planning. And the project planning, you must know which resources do we get from where? Which resources do we take where? When do we expect this project to end? When do we expect these guys here to come and report? But the one that you should never forget in terms of IFRS, in terms of IFRS setting, in terms of IFRS creation, the first thing from ISB is to have a meeting where they discuss the agenda. So agenda setting, very important. So if you have a pen, you can write them very fast. Agenda setting. Just a moment. I can see most of you have an idea of those things. I can see most of you already have an idea. Okay. Is there a net issue? So let's see. According to Mary Ann, setting agenda, planning the project, board review the draft. There is a point at which the board will review the draft and circulate to members. Research programs, developing a proposal, net issue, no. Is that everything? Is that everything? Is that everything really, you guys? Okay. I wish you could just list all of them. Discussion, developing and publishing discussion paper. There must be a discussion paper. There must be a discussion paper. There must be a discussion paper. At the tail end, I can see the board approving, the board approving. And of course, even after the approvals, there'll be what we call monitoring and what here, evaluation, monitoring and evaluation. Post implementation, yes. Issuance of the final IFRS. Issuance of the final IFRS. Aya, sasa nimewapatia time ya kuandika. Sasa si mnyamaze, hata mimi nisome sasa. Mnyamaze sasa niweze ku. Of course, as you are aware, hakuna ati one process, Hizo process ni mingi sana. Hizo process ni mingi sana to be followed. Whichever you decide to work with, where so long as you remain faithful to it. So number one is the agenda setting. The ISB identifies potential topics for new or revised standards and consults with the stakeholders to prioritize them. So what is the agenda? So we are saying that we must sit down and identify potential topics. Number two is project planning. The board develops a project plan for each identified topic, including a timetable, a budget, and a project team. After that, number three, we do a discussion paper. The board publishes a discussion paper that outlines the issues and the potential solutions for the new or revised standard, seeking feedback from stakeholders. If I share my screen here, ladies and gentlemen, if I share my screen, oh, somebody is saying, Mwalimu, you are too first. I just wanted you to take the, general. Just a moment. You see, if you're able to see my screen here, I want us to Google, you can also Google there from your side, the discussion paper. discussion papers for the new discussion. You'll be able to see how they publish them. Discussion papers for new IFRS, from ISB. What's happening? It's quite unstable. So discussion papers, they're not one, they're not two, for new IFRS. Inafanya like tena for new IFRS from IASB, the board itself. So ukienda hapo, you see, like now here we have IFRS discussion paper and the comment letters, right? We have discussion paper and the comment letters. These are for what these guys are planning to produce. Like now they are really planning to produce so many standards on environmental matters. They've already created a new body. So there must be a discussion paper that is produced. So the board, of course, through its technical committee, they'll come up with a discussion a discussion paper that they will be able to circulate to all member bodies, including CPA KENYA, and of course put on their website. So number one, tumesema agenda setting, where you would write that just alone, you'll be able to know how to explain yourself. Number two, we have project planning. They take this as a project. You know, a project has got a finishing time, starting time, resources, etc. Number three, we have the discussion paper. The board publishes a discussion paper that outlines the key issues and the key potential solutions for the new standard, seeking feedback from stakeholders. So that's why we are calling it discussion. So the stakeholders must give us feedback. Number four, we have exposure draft. The board publishes an exposure draft that sets out the proposed changes to the standard and provides an opportunity for further feedback. Exposure draft. The board publishes an exposure draft. Exposure draft. And then number five, we have the comment letters. Comment letters. The board receives and considers comment letters from stakeholders on the exposure draft. I never saw anybody mentioning anything to do with the public hearings. Remember, ISB is the one that knows much better about public participation. So after, in this case, they have gotten letters, they have the exposure draft, they'll call, in this case here, watu kwa mkutano. So kutakuwa na hiyo public hearings, the ISB holds public hearings to discuss exposure drafts and gather additional feedback. Right? Now, after that, now they prepare the final standard. The board issues the final standard, which becomes effective on a specified date. And then now we have the concept of going around the countries here trying, you know, it's an international thing, trying to encourage countries to adopt. So adoption, countries may adopt the IFRS into their own accounting standards, either fully or with modifications. So adoption, very important. Like now, very many countries are adopting IFRS 17. Then we have implementation and enforcement. Companies implement the standard and regulators enforce compliance with who? With the standard. Regulators like ISPAC now. And then lastly, we have what we call monitoring and review, where the board monitors the implementation of the standard and reviews it periodically to ensure that it remains what are relevant and effective, to ensure it remains relevant and effective. Now, what points will you never forget? What points will you never forget? What points will you never forget from the ones that I've spoken about? Of course, we'll try to make them a bit logical. So agenda setting, I like that. Number two, planning the project, isn't it? Planning the project, I love that. Number three. Sasa unaanza kufikiria mambo na nini? Na papers. Na papers ziko mbili. Kuna discussion paper, alafu kuna exposure paper ama exposure draft. Kutoka hapo unafikiria mambo na engagement, unafikiria mambo ya comment letters. comment letters and public hearings. Comment letters and public hearings. And then final standard. And then final standard. Final standard. After final standard, please don't forget the concept of adoption. You can even forget that one, but just have it. Adoption, trying to encourage countries that you guys, now we have this final standard, please adopt it. After that, of course, now we have enforcement. Like right now, all insurance companies by end of December, they must report on the basis of who? On the basis of IFRS 17. So implementation and enforcement. And then lastly, we have what we call monitoring and who? And review. Monitoring and review. So I believe in some way, sasa ikikuja, hautakuwa blank, ama ni aje, hautakuwa blank. Hautakuwa blank. At least utakumbuka agenda, utakumbuka project, it's a project you are taking. Wewe hata wanipati response woye, hata wanipati response. Tuko pamoja kweli ama walala kitambo? At least. Now look at part B. Many countries have adopted international financial reporting standards issued by the International Accounting Standards Board. However, due to local requirements and other challenges, some countries still prefer to use their own local standards. Like China said, useless IFRSs. Even USA, useless IFRSs. We are using our local IFRSs. We are using our local standards. So required, summarize 5 reasons why reporting entities would prefer to adopt IFRS. Why would entities prefer adopting IFRS? I'm giving you 2 minutes. I know you have an answer there. But I don't want you to look at it. I would want you to give me your own reasons. Why would the companies, in this case here, prefer working with IFRS, producing mimi kuna point nimeona 3, yani zinakuja tu. Zinakuja tu 3 mara moja. Thank you so much. I can see like what Fozia is telling me there. The first point that I saw, ladies and gentlemen, here is the concept of access to global markets, especially for purposes of borrowing. There is no way today you will go, for example, to South Africa to borrow from the stock exchange if you have not prepared financial statements that are compliant, that are IFRS compliant. You cannot be given any money by anybody there. So I will never forget access to who? To global markets. To global markets. Thank you so much. Before I look at yours, remember, IFRS, they basically promote a lot of transparency. We would want companies that you are able to see through. What we talk of see me through, right? Glass-like companies. So when you go the IFRS way, then automatically there is increased transparency. Remember, IFRS is all about you being required here to provide more detailed, comprehensive financial information, including notes to the accounts. There is improved comparability. If it is EPS, that is what we want you to produce in EPS. We'll tell you, for example, give us the basic EPS, give us, in this case here, the diluted, for example, EPS. All companies globally must do that. Improved comparability. IFRS provides a common language for financial reporting that allows for more meaningful comparisons of financial statements between companies, even in different countries. Even in different countries. Before I look at yours, there is the concept of reduced compliance cost. Companies that operate in multiple jurisdictions adopting IFRS can reduce compliance costs since they only need to comply with a single set of accounting standards. Instead of you're in Sweden, you're using their local accounting standards. You are in Kenya, you're using Kenya Accounting Standards, KAS. You are in Uganda using UAS, Uganda. So it means you'll really be incurring a lot of money to train accountants. And yet, right now, global companies would want to have all their accountants staying at one place. If it's Kenya, like Kenya now has become really a global hub. I think we are cheap. So you will come like the company that I work for, all the accountants are based in Kenya here. But we are serving 140 what here? 140 countries. And I can look at what you guys have, So what you guys have here, like a move to uniformity, relevance, comparability, transparency, and increased investor confidence. I love the last one. Increased investor confidence. I'll give you all the marks for here. Reduced time, yes, because these guys are learning curve is there. They've understood how to prepare these financial statements using IFRS. Then there will be reduction in terms of what year, in terms of preparation of financial, reduction of time, in terms of financial statement preparation like that. Thank you so much. Also the expense. I've not seen anybody talk about automation. When we have a single set of financial standards, then even to automate the financial reporting framework, the financial reporting process becomes what here a straightforward thing, becomes very easy, as opposed to having multiple what here, as opposed to having multiple financial reporting standards. So can I go to something different? I think that one now you have exposure. I think with that now you have exposure. But again, this semester they may ask you, why is it that there are countries that are against IFRSs? Why do we have some countries rejecting adoption of IFRSs? Why don't they want to adopt? I'll give you one point which you should never forget. They are seen to be very technical. If you look at, for example, financial reporting reports prepared by Chinese companies, they are 3 pages and they are more accurate. That is what they argue. Ours is how many pages? Even they're cumbersome. Right? We have an issue to do with language barriers. It means that if somebody in China would want to use IFRS, these guys don't produce their financial reporting standards in different languages. They only do that in English. That's a challenge. Now give me your points. My points already are gone now. My points are gone. I think I'm tired now. Great. 10 new messages. Great. Yeah, it's costly for them. Conflict of interest, I love that because at the end of the day, like we are doing some financial statements for a company in Finland, a company in Finland. And these guys are telling, hey, you guys, whatever figures you're getting, when we work with our methods, we're not able to get the same figures. So we have a conflict between this IFRS and some local accounting standards, which puts a very big challenge on full adoption on what year of IFRS. So basically the challenges, if I were to read for you very fast, the challenges, number one, the challenges of implementing IFRS. I don't know whether you are writing them. So number one, implementation costs. And they're explaining very well that adopting IFRS is costly, particularly for smaller companies, since it may require changes to accounting systems, etc. Complexities of the standards. Some standards like these standards of financial instruments, they are very heavy. I even doubt whether members of IASB really understand those standards 100%. They are complicated. They are complicated. They are complicated. They are complicated. There is the concept of resistance to change. Resistance to change. Employees don't really, they resist these new IFRSs because they prefer their own, the fear of the unknown. We have, of course, language barriers. Language barriers. Language barriers. Interpretation risks. What they mean with this is that if they make their financial statements using IFRS and they make their financial statements using local standards, the interpretations, the meaning could be a bit different. The meaning could be a bit different. Could be a bit different. Yeah, in this case here, we have this concept of what here they may be required to translate at the end of the day. They may be required to translate at the end of the day. So before we run away, listen and listen to me very well. Look at part C of this question. Integrated reporting is a concept that urges reporting entities to focus on the value creators within their business with a focus on the long-term success of a business rather than short-term focus on results. Remember, integrated reporting is more than a year. When you work with the old financial reports where you're looking at profit statement, then automatically you'll be thinking about end of the year. But integrated reporting, 5 years, 10 years. So they want us to explain 3 objectives of integrated reporting. Is there anybody who can give me those objectives? 10 of them actually. Before we disappear, I can see most of you are going. I don't know where you're going. IR is integrated reporting, integrated reporting. I like what Kamutu is saying there, the concept of holistic reporting, taking into consideration matters to do with the environment, climate change, sustainability, and of course numbers, and of course numbers, materiality, conciseness, I doubt, Merab comparison, I doubt. Objectivity of the objectives of integrated reporting. Objectives of integrated reporting. The people confuse these things. People confuse them. In the interest of time, you'll just allow me to read for you very fast. The first one is the holistic view of performance. And this holistic is a holistic view of performance. The objective of integrated reporting is to provide a more comprehensive view of an organization's performance by bringing together financial, environmental, social, governance information in a single report. This can help stakeholders understand how the organization creates value over the short, medium, and long-term view. So that what this gentleman called the whole. And then I never saw anybody talk about long-term, because integrated is about long-term. So long-term value creation. That's a major objective. Long-term value creation. Integrated reports is focused on the long-term value creation. That's a big focus. I don't know whether you have been able to write up to there. So holistic, where you are looking at the financials, you're looking at the impact on the environment, what we are calling sustainability report, impact on employees, whatever you are doing. So we have long-term value creation, We have integrated thinking. Please, this is a major objective. Integrated thinking. Integrated reports aims to promote integrated thinking, which involves breaking down silos within an organization and considering how different aspects of the business are interconnected. This can help organizations identify and manage risks and opportunities more effectively and make more informed decisions. Remember, ladies and gentlemen, the preparation of financial reports of those yesteryears, when we used to sit together as accountants alone. So basically, we were in a silo. A silo is like a closed room. where we are only thinking that financial reporting is about numbers, and then we're told no. Nowadays, in this case here, in terms of integrated reports, you must come and give us, for example, the strategy. What strategies do you have as a firm? What is the business case? How do you create money? So strategy, you need people from other departments. So in this case here, integrated reporting, ladies and gentlemen, promotes what we call integrated thinking. How are we developing these numbers in the company? What is our bottom line? Profit. How are we generating this profit in the company? So we need to talk to so many people around to be able to come up with a integrated. So the concept of integrated thinking is quite a major objective. It's quite a major objective. It's quite a major objective. And then we have stakeholder engagement, the same concept with integrated thinking. And integrated reporting, ladies and gentlemen, really it's a thing of stakeholder participation. Under stakeholder engagement, integrated reporting aims to promote stakeholder engagement by providing a more transparent and a comprehensive view of the company's performance, strategy, risks, and opportunities. We have number 5, accountability and transparency. Accountability and transparency. Integrated reporting aims to enhance accountability and transparency by providing a more complete picture of a company's performance, of a company's performance. So when they talk of integrated reporting objectives, ni gani uwezi ukasahau ukiambiwa summarize na jina moja. Objectives ama jina mbili. Objectives of integrated reporting. Objectives. Accountability and transparency, I love that. Long-term value creation. This is not a company that will run very fast in 100 meters and it disappears. No, long-term value creation. Long-term value creation. Long-term value creation. Integrated thinking. Stakeholder participation. Whichever Veronica, but it's supposed to be that HO, holistic reporting. Thank you so much. So we shall meet tomorrow at 8:30. Hakutakuwa na hizo confusions zimekuwa leo asubuhi. Tomorrow at 8:30, and I will be able to help you. My role is to help you in a way that you guys will be able to remember me in the future. So I want to help you as you revise. And it's my belief that from whatever we have tackled today, you guys have gotten some value, however small. Thank you very much. Bye-bye. Oh, I should be able to tell you what we shall cover tomorrow at 2 p.m. Great. Low-hanging fruits here. So shall be doing this low-hanging fruit question like first session. But the second session, please allow me to do theory. I know why. Because most students who fail in AFR, they tend to disregard the theory aspect. So Kimuliza, for example, what is the 3 P's of reporting? 3 P's of reporting. Hata kwambi kwamba nowadays, in our annual reports, in terms of 3 P's, we must report in terms of profitability, report in terms of the planet, that is environment, report in terms of people. How good are we to our employees? Unakuta wengi hatujui. Tukifanya double, thanks for asking, but tukifanya double, inatosha. Sasa jioni, unaweza kujipanga. Lakini kama sasa leo, you can walk heads high, at least umejua a few things here and there. Thank you. Bye. AFM, yes, AFM we have, but it shall start at 2:30. 2:30, pumzike kidogo, 2:30 to 5:30, 3 hours. Thank you.